Hello, ladies and gentlemen. It's Modern Investing on Pod TV. My name is Sasha Starr, and our guests for today are Dr. Milan Sombrak. Welcome to the show.
Thank you for inviting me. Delighted to be here. An honor.
Yes, and Jim Ede from Eid Foundation. Welcome to the show, Jim.
Thank you for having me, Sasha.
Okay, so as the market does usually on Wednesdays, and that's the reason that our show is on Wednesday, is obviously going up and going to
Green.
very seriously, a lot of greens, and I've did some adjustments yesterday and today, but basically it's still, although it's all hedged, I don't have any unhedged positions. All of them are hedged, but they're all quite aggressive. And I'll give you some example what I'm dealing with. For example, I just did adjustments today. I added a new position of symbol AI, stands for artificial intelligence. Very popular thing today. Stock is doing quite well. So I've purchased 1,000 shares, sold 10 calls. The calls are May 26 with 26 price, exercise price, right? Okay, the price that I paid for the stock is $25.40. So there's some upside. So even if it will be taken away at 26, don't forget about premium $1.40 and 60 cents on the way up. So we're talking about $2 in 10 days. Represents about 8% of the price of the stock. What's your opinion, Milan? Does it make sense?
What you're saying makes sense if you're into individual stocks, which we don't recommend.
Fund portfolio.
Okay, now
Now go.
One of our members does not have a fund portfolio anymore because during the fund portfolio experience that this member has had, he came across something so solid that he decided to transfer it to his core portfolio and not have a fund portfolio anymore. So let me describe to you, if I can, just what that involves. First of all, he's been getting 11.7% for a very long time, 11.7% for a very long time. And he's done that by selling covered calls on Schwab. The symbol for Schwab is SCH.
SCH.
Yeah, and so he's been doing that, and then when it gets called away, which happens half the time, then he's in cash. He sells just in the money cash covered puts. When the stock is put to him again, he now owns it. He can sell cash covered calls, and that approach has earned him, like I said, 11.7% for a very long time now. He decided not to have a fund portfolio because he's having so much fun doing this. Now, in order to do that, a couple of things. One is for Canadian investors, they need to open an account, a US dollar margin account. They need to open a US dollar margin account, which will allow them to sell cash covered puts. In the United States, investors can sell cash covered puts in tax advantaged accounts. In Canada, they cannot. So Canadian investors have to open a US dollar margin account. Then the other thing is beginning investors would have a hard time buying one board lot of SPY, which is the most widely traded traded fund, which tracks the S&P 500, because it sells for over $400 a share. They'll need to come up with about $40,000 or more in order to buy one contract, one board lot. You need to have a board lot to write covered calls, cash covered puts. But there's another security, SCHB, Schwab, which also tracks the S&P 500 and which sells for under $50. So beginning investors this applies both to American and Canadian investors who don't have the $40,000 to buy a board lot of SPY. They can buy a board lot of SCHB for under $5,000, and then go ahead with $5,000 only instead of over $40,000 to sell covered calls and to sell cash secured puts when the calls are called away from them, and then when they're in cash, they sell cash covered puts. And if that's put to them, now they own the stock again, the security again, they can sell cash covered calls, and they'll be making, this investor has been doing over 11.7% for a very long time. Does he need a fund portfolio? He doesn't think he does, because he's having so much fun, making so much money with so little effort. About 15 minutes a week he spends on his portfolio. So now, interestingly, you keep talking about market wizards, Sasha.
Yes.
And I had a chance to take a closer look at market wizards. Warren Buffett isn't even mentioned there. The name
He's not market wizard, period. He's not.
He's averaged nearly 20% for over 50 years. None of your market wizards have been around for 50 years. Over 50 years, 20%. Versus
maybe his health condition is better than most of the market wizards. I would admit to that. But all of them mentioned in this little book, all of them would be ashamed to make 20% a year or even a month.
For over 50 years. For over 50 years. None of them can match that.
Okay, all that says about his excellent health condition, but it doesn't say anything about its market wizardry. He's just
I'll tell you what that says to me. The author interviewed every one of these market wizards, and Warren Buffett turned him down. Didn't want to be interviewed.
He's not market wizards, that's why. There was very little he could tell him in interviews. Each interview is several pages. All what he would do, he would say, buy all American market, don't touch options, and so on and on and on. And it will take, say, 6.5 minutes, and that's the end of story. What else he could say?
By Berkshire Hathaway.
Oh yeah. Buy and die whilst you still own it.
And will it to your children, yeah.
Just good luck. Live as long as you need, okay, as long as you can, but don't touch the stock. Die with it. Put a claim in your will that it will go to his wife and some kids and grandchildren and grandchildren and so on and on. That's how
he is not a stock picker, even though he and his partner Charlie Munger might look like stock pickers, but they buy entire companies most of the time, not all the time, buy entire companies. And if these companies are traded on the stock exchange, and many of them are, then they look like stock pickers. They're not stock pickers. They keep saying we're not stock pickers. If they're not buying entire companies, they buy a very large percentage of a major company, such as Coca-Cola, for example. They own a very significant percentage of Coca-Cola. And so they bought the piece of the company and not an individual stock.
Well, they are market movers too, in the sense that when they do make a large acquisition of a certain stock, then it draws a lot of attention.
Sure. Yeah.
I'll tell you, I'm not buying into this myth.
Yes, I know, Sasha.
I'm not buying into it at all, because he claimed many times that he does not buy stocks, that he doesn't understand how the company really works and so on. And then he is at one time, I think he was the largest shareholder of Apple. What does he, at his 99 years, what does he understand in Apple? What is exactly?
Well, I will take no position on Warren Buffett or Berkshire Hathaway or his investment strategies. But I will say that it's very interesting that you pointed out SCHB, because, I followed Schwab stock for quite some time. I made a great deal of money in the late 90s off of it. It split twice, 3-2, and just was part of the dot-com bubble and I exited before it burst. So I've always been a fan of Chuck Schwab as well. I did not know about this SCHB. So thank you for telling me about that. It's very interesting because it is a way of playing the stock without investing as much. But I also noticed that it took a dive in March. It went from around 80 to around 50. And it's one of those stocks that is subject to swings.
Okay. Well, it is because it reflects the U.S. economy as a whole. It tracks the S&P 500. We can totally ignore that because there'll be many weeks when the premium income is smaller, sometimes much smaller than the drop in the market. But since we're talking about the U.S. market as a whole, we know that someday it will recover. So all we are interested in, that it keeps on throwing off cash every week, every Friday. We sell on a Monday and then cash in on Friday. And that happens all the time. Now, if you're dealing with an individual stock, it could fall out of bed. That has happened. You've heard of Enron, you've heard of Nortel, you've heard of
Sure.
Pennsylvania Central Railroad. Many companies, individual companies, have dropped and fallen out of bed. And so that's why Sasha doesn't like the idea of dollar cost averaging. True. Dollar cost averaging doesn't work if a company is going to fall out of bed, but it does work if you're buying the American economy as a whole. It's true that empires have 100% failure rate. However, it takes a very long time. The U.S. economy there's no visible.
And you don't think the Visigoths are at the door?
Milan, of course, you are indirect owner of a wonderful company by the name Walgreen Boots. It's part of Dow Jones. It's part of S&P 500. So you are the proud owner of that company.
Okay.
So just not too long ago, when the stock was about $60 a share, actually 3-4 years ago it was $85 a share, but just a few months ago it was $60 a share, and there was talk about selling their division of Boots to outside investors or a new company to be formed or whatever. That never materialized, and it's one of the reasons the stock went down from $60 to where is it now, around $31, maybe $32, maybe even less. But look, since you own S&P 500, obviously you are the proud owner of the stock. It's a part of the U.S. economy. It will recover for sure in next 30, 35 years. It will recover. There is no doubt about that. So why would I, as much as I love U.S. economy as a whole, own the stock? I would rather own 499 other stocks in S&P 500, and I wouldn't touch this one. But in your grand scheme, you must own 500, not 499 stocks, 500. Make it, do it.
Of the 500, there will be some that are not that great. And somebody mentioned a while ago on this show to take a look at the S&P 100, which I did. And the S&P 100 tracks the S&P 500 just about exactly. They have taken only 100 stocks instead of 500. They track the S&P 500 precisely. So now you're talking here about stock picking. We're going to eliminate all the bad ones, the bad performers. And so the Market Wizard story shows us that is possible and has been done. And if it's been done before, it's probably possible. But I haven't been able to do it. And so would most investors. Most investors would say that. So even though
there's a book called Market Dummies along with Market Wizards. It's bigger. It's a very thick book.
It must be.
So you know that Buffett and Munger, who appear to be stock pickers, now want the average investor to buy an exchange traded fund which tracks the S&P 500. That's it, and then perform as well as the American economy. Now, I did a study once of various markets, including DAX in Germany and the Japanese market, which has done terribly over the last 40, 50 years or more, and the European market. And so we compared half a dozen markets, and the U.S. market is way ahead of all of them. Someday that will change. but I don't see that any evidence of that happening in my lifetime.
No, on that one, I agree with you. Is that U.S. market, the stocks are much more liquid. They are having much more support. All the rest of the world, they're all essentially they're buying U.S. stocks.
Yes,
So that some of the stocks are trading on other exchanges besides U.S.
sure.
But even though they still prefer buying it on U.S. exchange because it's deeper, it's more liquid, it has a lot of action, and so on. Now, again, if, as you say, most of the people are losing 40% in their fund portfolio,
Right.
if Warren Buffett says that you have to buy American market as a whole, so I have a huge dilemma, because if I made more than 40% in the last 6 months, I have to sort of say that, you know what, I was wrong. Warren Buffett is right. I have to sell all of it, buy S&P, maybe even buy separately Walgreens just to add a little bit more to my misery as an S&P holder, just to buy another couple of thousand shares of Walgreens. It's actually, it could work for some people. They're paying now very good dividend. It used to be 4.5%. Now it went down so much. So maybe it's even better.
Maybe it's a dividend stock.
Yeah, you know the theory of dogs of the Dow.
Yeah.
This is a perfect dog. There is no one better today than this. So maybe
Sasha, I wanted to get back to, you started the show with AI, and I noticed, just briefly looking at it, it was pretty flat for a while, and now it's kind of on the uptick.
No, actually, no, Jim. There was a period when I first started to look at the stock 3 weeks ago or 4 weeks ago. It went down from $30 to $20 overnight, because as a short sellers, they just announced that there are some irregularities in their financial reporting and so on. I really don't know really what's happened with that.
Well, I mean, over a longer period of time, it was pretty flat. There's now volatility, but the volatility is tending upwards.
Mm-hmm.
And I wondered if we can attribute it to, we just had an AI expert speak to Congress, and I wonder if it's because AI is just in the news more there's more content about it. If then anything fundamentally has changed about that stock, I don't know, because I haven't superficially looked at it. But it seems to me that this may be one of those things where people are not using their intelligence, but rather are attracted to the shiny object in the room. Like AI is now a shiny object, and people are
very possible, Jim. It is very possible, because of course now everybody's talking on all channels, on CNBC and everywhere else, about artificial intelligence. Elon Musk interview just on CNBC right now. So at least it's a part of the trend, or maybe it's trend on its own. So you are going into the trend. And as Milan knows, it's your friend.
It's your friend.
So what can I say? My position is hedged. And of course, I'm limiting my earning potential on this trade. However, I feel somewhat safer that even if I paid, say, $25 for shares, which were available at $20 just 3 days ago, but it's different situation. It's very dynamic situation. If it's $20, when you want 19 back to 20, it can go either way. But when it's so strong that it one day it went up $3, $3.50 maybe, then it went down $1, maybe actually 40 cents, 50 cents, and then it continues to jump. So it is indeed sort of a trendy situation. Again, I don't believe it 100%. In this situation, I don't know how long it's going to be. I'm selling covered calls to protect somewhat so my downside is still, there is a downside, no doubts about that, but it's limited. And also by the time that 26, so it's next Friday, it's
Yeah, you always take action to protect yourself on the downside.
Always,
Yeah.
always. I'm not, I can hold stock unprotected without selling covered call for about half an hour. Why? Because if the stock is really moving well higher and I'm getting there and it's getting at some point and it stops. And only then at that point I'm selling covered calls.
I
So I'm
see.
taking advantage of a movement.
If the stock drops 7%, Sasha, you're selling it. Did you say somewhere along the line if a stock
Yeah.
drops 7%? That's the opposite of buying bargains, isn't it? And a stock drops. If it's a
You know
good
what?
stock, then
I'm very skeptical about buying bargains. I'd rather to buy stock which is moving higher,
Yeah.
and if I already have position in that stock and it keeps moving higher, I will add. There are some actually stocks
that
that I
works.
add.
Unquestionably, I've seen studies, I've seen peer-reviewed studies about momentum investing, and unquestionably, it works. The downside of momentum investing is it needs constant attention. And so buying an exchange traded fund which tracks the S&P 500 needs very little attention. Now, one of the best things that I got from Market Wizards is all investors should understand the efficient market hypothesis. And none of your wizards fall into the efficient market hypothesis category because they are beating the efficient. The efficient market hypothesis states that share prices reflect all known information, and so stocks are always trading at their fair market value. And now that's
Okay, you can accept that.
no,
I
there's
just
a better there's a
it just doesn't help you to make any money, but you can accept it for what it is. That's okay.
there's a better explanation of the efficient market hypothesis in Market Wizards than any that I have seen anywhere else. The business schools all teach the efficient market hypothesis with some caveats. There's some caveats. So, for instance, Burton Malkiel wrote a book called A Random Walk Down Wall Street, a wonderful book to read. And so he said that the efficient market hypothesis, nobody can have an advantage because the stock prices reflect all known knowledge. And he said in his book that blindfolded monkeys throwing darts at a stock quotation page would outperform professionals. So the Wall Street Journal did that for 14 years using its reporters to throw darts at a page and compete against professionals. And the results were indistinguishable. Now, can you imagine? I'm a dentist. That I would want to compete with somebody off the street about removing a wisdom tooth. Somebody who knows nothing about root canal treatment is going to compete with a qualified person. Somebody who is just a lovely guy who is going to build a bridge better than an engineer would. No professional would even consider competing with people off the street. Yet these market advisors and planners and so on all did, and none of them did any better than the.
Well, don't forget, most of them are out to sell you something. Their job is
absolutely,
not to necessarily predict the market.
Oh, absolutely. Yeah,
no, but there is one person well known to you who did that. It's Warren Buffett. Mm-hmm. How could he did this? Outperform all professionals, everybody else.
I don't think he's sharing his secrets. I think he's doing some things that he doesn't. He tells the public certain things that sound wise and great wisdom but he's doing things that are contradicting his own advice, in my opinion.
Jim, you know what he did, in my opinion? I think he purchased 10 blind monkeys and asked them to throw darts. That's what makes him so successful.
Well, for over 20 years, I owned nothing but Berkshire Hathaway.
Right.
And I used to go to the meetings that they have in Omaha. And one of the things that struck me particularly is Buffett and Munger talk about their failures a great deal. And the people you can least trust are the ones that just talk about their victories. That, like you said, Jim, they're selling.
That's true in chess too, Sasha. The guys who only show you their victories, don't listen to them.
Yeah, that's right. Yeah, so Buffett and Munger are not afraid to talk about their losses. They constantly talk about their losses. Makes them human.
Yeah. Well, it's a fact of life. If you're going to be in the market, you're going to make some mistakes, and that's why you stay disciplined, because you don't get too proud of yourself when you're successful, and you don't get too down on yourself when you're having struggles, because stocks go up and down, and sometimes you're wrong.
Oh,
And
hold on. I must admit, I took a loss today to free money to buy artificial intelligence AI stock. I had a small position in AMD. I had 100 shares and I sold one covered call. And guess what? I took a loss in that position. I had a loss of $64 on stock, and I had a profit of $43 on covered call. So I lost $21 after commission on that trade. But I was able to free more cash to buy artificial intelligence stock. So there are losses, of course, and I don't mind to have losses from time to time in order to move into, in my opinion, more promising positions.
Well, that's the thing, is to recognize when you were wrong and not get stubborn about it, and change your allocation of what you're investing in. I don't do it very often, but I do it, and it's one of those things. Like I think the S&P 500 is probably a little tech heavy right now, and that's kind of going to go with the swings of that industry, and these are the types of things that I try to pay attention to, because these things go in and out of fashion, and like that's why I'm a little suspect of AI right now, because I just think it might be a fashionable trend and not based on anything that I would really sink my teeth into.
Well, it will be broken sooner or later, and in fact, it could be as soon as this summer. It could be, say, July, August, September, October are horrible months. So we are in a very advantageous. You see, the earnings reports are all wonderful. Look at it's coming now. Palo Alto Network, 23rd of May. Nvidia. I doubled my position on Nvidia.
Really, because it popped today too.
Yeah. I keep doubling.
We've been talking it up in the show for a long time, and it's doing.
And it has. See, Jim. Here is what I love: that the stock is so huge trend on the way up. You can't ignore it. I was thinking at one point even to sell everything what I have and just concentrate only on Nvidia. But okay, I have some Palo Alto and Network. I have artificial intelligence. But again, it's all heavy, high tech.
But you came close to taking your fund portfolio and putting it into your core portfolio and making the entire thing your core portfolio. Yeah.
No, I'd rather liquidate some of my position in a core portfolio and move this money into fund portfolio.
Well, we talk about mistakes.
They're two different universes. I can't mix them. It's impossible.
We should look at our mistakes. We should look at our mistakes as practice shots and learn something from them.
Try to learn from your mistakes. Play over your losses as a chess player. This is some of the best advice I ever got. Because you learn from your mistakes. If you're objective about it, if you're going to pretend that you didn't make a mistake, you're not going to learn.
Can we do even better than that by learning from the mistakes of others?
Yes.
Is that possible?
Absolutely.
No,
Or is it realistic? Is it realistic?
It's not realistic because others' circumstances are very different from your own.
Yeah.
And if others are doing certain strategies which are different,
Yes, but
doing.
Sasha, if you're playing over the games of the old masters and you see mistakes that they make, then you see that, I've learned something from
Jim,
that.
the circumstances of chess games are much more similar to
That's very true.
The same position,
That's very true.
same openings, and so on. Now, in this universe, for example, let's see, you have, you're watching a stock. You don't have any position in the stock. The stock can move higher, it can move lower, and it can stay the same for a certain period of time. Now, what's your reaction should be? Should you buy? Should you stay away? Should you sell short? if you think that down start moving. There are so many different opportunities. For example, you may think that, okay, you don't have any opinion on what's going to happen to stock. Okay, you take a look at some other stocks. And the best way to look at your own stocks, which you already have, because you already have understanding of what is the stock is, what's company doing, whether it's moving higher or lower, what are the earning reports, or so on. So it's much better. That's why I'm not diversified at all. I have 4, maximum 5 stocks. I don't need
Very
diversification.
good. Very good. Yeah.
I don't want diversification. The most money that I ever made in stocks when I owned single stock, maximum 2, 3 stocks.
That happens to be true for me too, Sasha.
Again, exactly. So
Yeah.
when you see the stock is moving high, right now my portfolio is about 60% in NVIDIA, 20% in Palo Alto Network, and 20% all this artificial intelligence and some other stuff, okay, put together. I actually have closed position, even Google. I had covered call and stock. I closed it today because I wanted to free money. Okay, let's see, I have money on my account, cash. What is a better buy, Google or artificial intelligence? Google is about $120 a share, artificial intelligence $25 a share. What is
And Google, everybody knows the information about Google, but they don't about AI. And so,
Well, AI, it's getting around, but I think it's good
Yeah.
enough around to $30. What's
Yeah,
happening next?
yeah.
I don't know.
But you're talking here, Sasha, you're talking about put all your eggs into one basket and then watch that basket.
Yeah, anyway,
Well,
yeah, it's true.
well, in the fund portfolio, he's talking because there's another basket. So, yeah, we have to keep that in mind that we're talking about discretionary funds when we're talking about
Absolutely.
focusing on one.
Only. And also don't forget that basket, even something happened to it, it doesn't happen in a split second. It's happening, first of all, the stock, before it goes down, it has to stop going higher. Then you see there is a resistance. It pulls down, then it's trying to climb higher, but it cannot break certain level. So you already know that you have to run away from that stock because too much resistance. Maybe it's already distribution time, so professionals are trying to unload the stock that they had for so long. But I don't think it will happen with NVIDIA before the earnings. Now, it could be awful earnings report for NVIDIA. Never happened in the last several years, but could be. So I could unload the stock a day before the earnings. I could do that. Depends on the situation and so on, or at least half of the position. I may do that. I
So
did.
because you're monitoring the situation, you're always got some built-in safeguards against it.
Absolutely.
And
Yes.
So that's what I admire about what you're using discipline, which I think is one of the things we want to
Yes.
telling people. As long as you're disciplined, you might make mistakes. Of course, everyone makes mistakes, but you're going to be okay in the long run.
Of course.
If you
No,
follow your rules, the rules make sense. You follow them, and the market is a good place for you to be if you want to increase your wealth. And it's just simple.
Yeah, it is. It is. And you're talking about rules. There is rules-based investing and judgment-based investing. And judgment-based investing is wrong much of the time, at least half the time. So we should limit our investing to judgment as much as possible and stick to the rules.
Yeah, and when you say judgment, also I would also include the word perception, because sometimes perception is what it fools us.
Yeah,
we perceive value where there is none.
Yeah. Oh, that happens a lot. Yeah, the psychology of investing has a huge impact on the outcomes, doesn't it?
It really does.
Daniel Kahneman, who won a Nobel Prize is actually not a market man. He is into psychology. He is a psychologist. Won the Nobel Prize for investing, for money. Psychology plays such an enormous role in market movement. Who said the market can stay illogical longer than you can stay solvent?
Okay, I forgot to mention one other addition to my portfolio, but it's a small one. I bought only 100 shares of Amazon. Amazon is well-known stock. Everybody's following Amazon. And it's been doing nothing for a long time. And now I noticed it started to move. How long is going to be that move and how far it could go? I have no idea. But I purchased it at 114.77. It's now
Do
115.25.
you look at volume, Sasha? Because that's important, isn't it? The
Yes.
volume.
Yes.
Yeah, of course.
Yes.
Sure.
And that's no question. Amazon has value.
Yeah.
I'll tell you what it is. It's almost 40.5 million shares. The usual average volume is 60 million shares. So it's done about 2/3 of daily volume. But again, it's moving up, and stock widely known and distributed like Amazon for it to move. What is it? Today move 1.5% in a
That's,
single day. It's a substantial move, I'll tell you.
Well, Sasha, did you get attracted to NVIDIA because you saw it moving? Was that what got your attention? Because I came at it from a different perspective.
What video do you have in mind?
NVIDIA, the stock.
Oh, NVIDIA. Sorry. I thought you were talking about NVIDIA. No, NVIDIA is my core. No, we have my core. Unfortunately, doesn't have NVIDIA. I must admit that. But my fund portfolio compensates me for that. I'm watching NVIDIA, of course, every day.
But why did you buy it? Because you saw it moving in an attractive.
First of all, I was expecting after a great earning report. Just recently, I was expecting that there would be a gap, and that gap, at least partially, would have to be closed. So let's see if stock was after report, it was 275, I think, something like this. And before that, it was 230, 240. I thought that it would come down just to 260, even that much. And then I wanted to jump in once it will start to reverse its course. But it never happened. It went down to maybe 272, and that's it. Could never go even below 270. So when I realized that, I understand that there will be another report, which will be next week on 24th. So as it's happening usually with NVIDIA, it will keep going higher. How much higher? Well, now you can see that $300 will be.
300, yeah, it's approaching that. Right?
It's just any time. So if I know all that, and I will not buy NVIDIA, my wife will divorce me.
Our prime motivation.
That happened to me, say, 30 some years ago when I was in that penny stock, which was going higher and higher, and I recommended to my friend to buy it. The stock was maybe $1.50 or so on, and he said that it's not the money issue. It's psychological issues. Okay, he can buy stock. He'll make probably $1,000 to $2,000, but it could be a scenario that he will buy stock and it will go down, and he will sell and he may lose $100. So his grief of losing $100 is way much stronger than his joy of winning 1,000 or 2,000.
It's kind of greed and fear always wrestling with each other.
And in his case, of course, grief is a winner. Anyway, when stock went up to $4.60, his wife almost divorced him that he didn't buy the stock. And because he knew about it. And although I must admit they divorced several years later.
Yeah,
but they could do it much earlier.
Here's an interesting story I found really interesting about penny stocks. Here in Collingwood, where we are, there's some shale, and shale often has oil and gas in it. So they started drilling, a group started drilling in the shale, and then one night they came in and dumped in some oil down the drill shaft. And the next morning, the tools came out oily. They said, "Oh, we struck oil." And wow, people were begging them to buy shares. And then they took the money and disappeared.
Yep.
Yeah. So Oh.
And
Yeah. Funny things are happening with Benny stock. It's a
there's
separate
always the
story.
con artists.
Yeah.
Yep.
Anyway, we still have a good day today. Everything is going higher. Everything is green. Let me see if I have anything red in my portfolio. I have
I was
red.
all green today too.
Okay, I have red, I must admit, in Palo Alto Network. Yes, I have red there. But what I did, as I said on the previous program, I sold cash covered puts,
Uh-huh.
and because the stock was down for the last 2 days, and today it's recovering already today, but they have earnings next Tuesday, so I'm fine with that. And not only that, to protect my position even further, I sold calls, which are they're semi-covered, if I can say so, because of my puts, and I will end up being exercised. So at that point, I will own shares. So the calls which I sold are partially or are covered in a way, technically speaking. Because okay, the stock, for example, stock is today 192 a share. Okay, I sold 200 puts. The exercise this Friday, it's the day after tomorrow. So you can bet any money that I will be exercised. So I will own the shares now. However, I've already sold without waiting for exercise, and then only Monday I could sell the covered calls. But what's happened is the stock will go somewhat lower, then my premium will be affected. And I'm being greedy. I want to get a good premium from my covered calls. So I've already did it today. I've sold covered calls. So now I'm waiting to be exercised. So this partially covered calls become fully covered calls, and I will have shares, and then I will play it by ear. It depends on their earning reports and several other factors. But that's the only red position in today, and I would gladly liquidate this position even with the loss, except that I don't have stock. I have options on both sides.
And
So
it's been trending upwards anyway. So
no, I'll just wait until Friday. I will be exercised, and then next week I will have normal position, shares, covered calls, and so on. So I'm just in a precarious situation until Friday. Okay, but
And your wife won't leave you.
no.
no, no, I can guarantee you that. Actually, she always look at my positions, and she always questions me. Why would you do this, and how would you do this? Oh, okay, now I understand. Okay, good. So everything works fine. I would like to thank you for today's program, and let's meet next Wednesday, same time, same place.
Looking forward to it. Thank you for inviting me.
Thank you. Bye, everybody.
Bye.
Bye.